Hello and welcome to my YouTube channel. Have you ever wondered how many shares you should own in your portfolio? In this video, I will explain. It starts right after the intro. Stay tuned.
Insights for the informed investor.
The topic of how many stocks to invest in can be confusing for some investors. Because on the one hand, there are super investors who say that broad diversification of investing is the most important thing to get good performance. On the other hand, Warren Buffett says that investors who claim that broad diversification, as is common on Wall Street today and is also taught in colleges and universities, makes relatively little sense. What should we do now? It is dangerous to follow one piece of advice and ignore the other. First of all, you should understand that a portfolio that has perhaps over 60 stocks, plus commodities and government bonds, can be just as harmful as a concentrated portfolio with perhaps 4 or 7 stocks, as recommended by Warren Buffett. You can ask yourself the question here: how can it be that both investors are perhaps among the best in the world and have such different opinions on such an important topic for the private investor? In this video, I will try to clarify how many shares you should own in your portfolio. With this video, I try to provide some clarification because you can already make very clear recommendations. Warren Buffett's opinion on diversification.
Diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably.
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
In the course of the video, we will clarify exactly what is behind this statement and why it is correct in principle, but could be misguided if you stick to this recommendation exactly. Let's first look at whether Warren Buffett himself sticks to his recommendations and how he built up his portfolio in the past, and then how he invests today. Does he stick to his concentrated investment approach himself? In 1960, Warren Buffett invested about 5 to 10 stocks in generals in his Buffett partnership portfolio, with a weighting of about 5 to 10% per position. This represented about 50% of his portfolio. Why did Warren Buffett actually call them generals? Generals, in his mind, were stocks that were undervalued. The next 25% of his portfolio were smaller blocks of stocks with a weighting of less than 5%. There were about 10 to 15 stock positions. This left the remaining 25%, which he also filled with around 10 to 15 share positions, but he called these workouts. These were shares whose value was largely dependent on the company's capital measures. In total, there were always around 30 shares in his portfolio at any one time. If he found a good opportunity, a single position could account for up to 40% of the portfolio's total weighting. It must be said here that Warren Buffett invested in many smaller companies. According to his own statement, his private assets were only invested in a few shares at the time, on average about 10 share positions. The whole thing was not publicly accessible. Today, Warren Buffett invests his private assets and those of his family in just one share, Berkshire Hathaway, the company where he himself is managing director and looks after the company's investment portfolio. Today, he manages $331 billion at Berkshire Hathaway. He is invested in 41 companies. He also holds cash amounting to $185 billion. Today, the top 5 positions account for 76.26% of the entire portfolio. If we take the top 10 positions, it is even 91.19%. Although Warren Buffett is invested in 41 companies, he is heavily invested in the first top 10. Warren Buffett himself said that he would like to have his equity portfolio more concentrated. Due to the amount of capital he manages now, it is not possible. We know that the capital is around $331 billion. Let's imagine Warren Buffett gets rid of his top 5 stock positions and buys one position. He he would have to invest over $250 billion in a single company. How many companies in the USA have a market capitalization of $250 billion? Even a transaction of that size in shares of one company would take up perhaps more than 50% of the shares on the open market. Unfortunately, it's not that simple anymore. However, it can be said that at the beginning of his investment career, he divided his portfolio into 10 to 15 shares. This means that his investment approach, as he said in the video, was never that concentrated. In an interview, Warren Buffett said that you only need to find a handful of good companies in your life to make a fortune in the companies. So far, it is considered correct to confirm cautiously. Now we have described Warren Buffett's point of view. Let's move on to the other point of finance, namely, diversification. What is diversification? Diversification is a strategy that aims to improve profit opportunities or reduce the risk of loss by expanding services or business areas, or by spreading risk. In other words, the opposite of specialization towards monostructure. Here, the standard deviation of the investment results is used as a measure of risk, and the curve of the standard deviation of the investment results. It can be said that a large part of the risk has already been reduced after just 5 shares. If there are now 25 shares in the portfolio, the diversification benefits will be exhausted. With 30, 40, or 50 stocks in the portfolio, it hardly makes any difference to the security of your equity portfolio. Let's look at how we can practically approach stock selection. If we have a list of companies that we find interesting, we can start by filtering them according to certain criteria. These criteria could be financial ratios, such as the price-earnings ratio, return on equity, or sales growth. Qualitative factors such as the company's market position, management, and competitiveness should also be taken into account. After the pre-selection comes the detailed analysis. Here we should take a close look at the company's annual reports and balance sheets. What do the profit and loss statements say? What about debt and liquidity? Are there any major investments or provisions that could arise in the near future? A thorough analysis helps us to better understand potential risks and opportunities. In addition to the financial and qualitative analysis, we should also keep an eye on macroeconomic factors. How is the sector in which the company operates developing? Are there any political or economic changes that could affect the market? A comprehensive view of the entire environment helps us to make more informed decisions. One important point that we must not forget is to regularly review our portfolio. Markets and companies are constantly changing, and what is a good investment today may look different tomorrow. Regular reviews and adjustments to the portfolio are therefore essential. This does not mean that we have to act all the time, but we should be prepared to reconsider our positions if the framework conditions change. To summarize, there is no hard and fast rule for the optimal number of stocks in a portfolio. It depends on many factors, including our risk appetite, the time we can invest in analysis, and our financial goals. A concentrated strategy like Warren Buffett's can be very successful, but requires a lot of knowledge and discipline. Broader diversification can offer more security, but again, thorough analysis is essential. Now let's imagine that you want to have 30 shares in your portfolio that should be fairly valued. How much time do you need to evaluate the 30 companies? For me, it takes between 1 and 2 weeks to thoroughly evaluate a company. What do you need for a reasonable evaluation of the balance sheet figures for a company? Please write me your answer in the comments. In conclusion, I would like to emphasize once again that it is important to be well-informed and make sound decisions. Investing is not a game of chance, but should be based on solid analysis and a clear strategy. If you enjoyed this video and would like to see more content like this, subscribe to my channel and activate the bell so you don't miss any future videos. Feel free to give me a thumbs up and write in the comments how you organize your portfolio and what strategies you follow. Thanks for watching and see you next time.